Selecting the right option strategy can be a daunting task, but don't fear. We're going to be breaking down which option trades are best given the current market environment in today's installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. And joining us here to discuss is Sean McLaughlin, All-Star Charts Chief Options Strategist. Sean, thank you for coming here today. I want to show the viewers at home the Wi-Fi interactive, and hopefully you can see this too. I've been showing this screen all week. We have calls and puts. You can go long a call, and that gives you the right to buy a stock. You can also short it. That gives you the obligation to sell it, and vice versa. But what I want the viewers to see is a quadrant system that you've come up with to help you find the right options in the current market environment. We have a scale going up and down of bullish to bearish, and then from left to right, low volatility to high volatility. And we've put one example of what you can do in these different quadrants, but there are many more strategies. Could you just kind of break this down for us?
Sure. Hi, Jared. Thanks for having me. And what we're looking at here is just a sample of ideas that one can do based on the implied volatility environment that we are in currently. So I've seen the episodes you guys have done so far this week. You're doing an excellent job of covering a lot of the basics and options. The next step when you're about to put an options trade on is you don't want to just buy a call if you're bullish or buy a put if you're bearish. You want to take implied volatility into consideration to stack the edges in your favor. Because what happens is, in a high implied volatility environment, you are going to pay a higher premium, for example, if you're buying just a simple call, right? And if you're paying a higher premium, that makes it harder for you to earn an acceptable return if you get that trade right. On the flip side, if volatility is if volatility is low, then premiums are very cheap, and you don't want to be doing credit spreads. You don't want to be selling strangles, things that bring in premium, because you're not getting paid enough to compensate for the risk that might happen if a directional move happens in the wrong way or if volatility were to rise. So knowing the volatility environment is key to selecting the strategy you want to use to maximize your odds of success.
All right, and the VIX has been pretty low lately, at least on the indices. We've seen some pretty low implied volatility, but I want to break down a couple trades on the Wi-Fi interactive here. Taking a look at Mosaic, that's ticker MOS, and you're looking to buy the $30 put with an expiry in June of 21 this year, and we have a profit and loss chart. Could you kind of break this down and how you're thinking about it and how that ties into what you were just describing?
Sure. Well, this is a trade that doesn't come along very often. Typically, when a stock is breaking support and getting to lower levels or the lowest levels it's been in a while, you tend to see people, hedgers, people who are long, who are worried about the position, they tend to use the options market to insure against a large loss. So they'll purchase puts to protect their long position. And when they're purchasing puts, that drives the premiums of options up. But in this case, in Mosaic, right now, at least the time we put this trade on yesterday, the implied volatility in these puts were very cheap, the cheapest it's been in for most of the past year. And so we saw an opportunity where the analysts or the analysis that we've done here at All-Star Charts, we think that Mosaic, if it follows through in the downside, could trade as low as $23 over the next couple of months. So we saw that the June 30 puts were trading for $2 a contract. If Mosaic gets down to 23 before June expiration, those puts will be worth at least $7. That's what the intrinsic value will be at that point. Then we're looking at least a 3x return on our $2 investment, which is what we paid for those puts yesterday.
That seems quite attractive. Great risk reward. We have time for one more. So I want to get quickly to this next trade, which is Lululemon. You're doing a bear put spread. And just quickly for the viewers here, a bear put spread is when an investor purchases a put option while selling the same number of puts at a lower strike price on the same stock, and that's with the same expiration. So here we're buying the 420 puts and selling the 380 puts with an expiry of April 19 for Lulu. What do you think about this? Break it down for us, please.
Well, with the Mosaic trade, we just simply bought puts, right?
Yes.
In this case, we're buying a put spread, and there's two reasons why we did a put spread. Number one, the implied volatility in Lululemon options was a little bit more elevated, so it was more expensive to just buy puts in volatility terms. Also, the fact that it's a nearly $400 priced stock means that options just in absolute terms are more expensive. So by creating a spread, by buying one put and selling the further out of the money put, we lower our cost of participation, we increase our odds of success. And if Lululemon can't hold the levels that it's at right now, or I'm sorry, if it can stay below the levels where it recently was, we think that there's a failed breakout in play here in Lululemon. We think there's a lot more downside to go, and we're looking at maybe 390, 380 over the next 4 months.
All right. Really appreciate you stopping by here for Options 101 1 week. Sean McLaughlin of All Star Charts. Stick around, all your market coverage when we return.